Hi all. Thank you for joining us in this webinar. My name is Haris Lipiridis. I'm an infrastructure specialist at the Global Partnership on Output-Based Aid, and I will be moderating today's webinar on results-based climate finance. I'm here with Klaus Oppermann, who is a senior carbon finance specialist at World Bank's climate change cross-cutting solution area, and has recently, in collaboration with other colleagues, has produced the report on results-based climate finance that we'll discuss today. This webinar is part of a series on innovation in finance, which introduces innovative financing mechanisms that contribute to development of solutions, linking needs, objectives, and actual results. This series is focusing on results-based financing, in particular, which has emerged as an important tool for financing basic services because it changes the focus from inputs to outputs. So from funding given in advance for expected results to verified outputs. As a center of expertise for results-based financing, the Global Partnership for Output-Based Aid brings together results-based finance practitioners like Klaus and development partners to share results, experiences, and lessons on RBF. We have an exciting presentation in front of us, so without further ado, I would like to give the space to Klaus in order to present his work on results-based climate finance.
Yeah, thank you, Haris. Welcome, ladies and gentlemen, to this webinar. So let's get started in discussing really what's the purpose and the rationale, so to say, for undertaking this study on results-based climate financing was, and then move to an overview of where we are in results-based climate financing in terms of overall volumes and in terms of characteristics of existing programs using that financing approach. We will then move to a couple of examples, and at the end, I will offer some conclusions to open up the discussion. Now, what is the purpose of this report? Basically, what we wanted to do is to map the landscape of results-based financing in climate. As you are certainly aware, results-based approaches have a long history in other areas like health and education, but they are still in its infancy in being applied to climate change. This is not yet meant to be an evaluation or a guidance document. For that, we feel it is too early days. It is really meant to be an overview of the landscape on results-based financing, of the various design aspects of programs, of real-world programs, a discussion as well on how suitable results-based approaches are for climate change, both mitigation and adaptation. That is why we will assess the practical experiences made so far with this approach in climate, with the existing conceptual thinking and literature on results-based approaches. What we did in that review, we identified as many programs as we could. We came up with 74 programs of different size, of very different types, using this approach in climate in developing countries, and we analyze the features of these programs, not only in terms of what the programs are targeting, but also the way they are designed, and if possible also, because this is early stage, as I said, the first lessons learned with these programs. Why is this an important topic? Why are we talking about results-based climate financing? Because let's face it, as a financing instrument, results-based approaches, at least in the climate space, are for the time being rather a niche product, despite what I will present to you in explaining you the key design features of the 74 programs we looked at. But as compared to overall climate finance, results-based approaches are still tiny. But so why talking about it at all? And that is the strategic context in which we undertook that and outrolled that work. As you are aware of, and as it is obvious, there are basically two main pillars of international cooperation. One pillar is climate finance, and the other pillar are climate markets. Now, these two pillars were in the past very much siloed, isolated from each other. And with the past, I mean the days of the Kyoto climate regime, where climate finance was rather not, I think it is fair to say, deployed in a strategic and focused way on achieving transformational change and really to mobilize the resources needed to deliver mitigation, but also adaptation to the scale required. And carbon markets was a mixed experience. Basically, a proof of concept was achieved, but markets were plagued with major problems, both on environmental integrity and stability, in particular price stability. Now, with the Paris Agreement, we have a chance to avoid the mistakes of the past because we take a fresh look at these topics, and we are in an early stage of designing the instruments both under climate finance and under climate markets and carbon markets. And that opens up an opportunity to really focus climate finance on supporting domestic policy processes, supporting market creation and markets we will need to achieve below 2 degrees and to achieve the adaptation that we need to the unavoidable part of climate change. And that this climate finance can become subsidiary to markets once they are established and then move into other areas of application that markets cannot yet reach. And markets on the other side can much more build on domestic policies and domestic targets, that was the case in the past, and can adapt regulation that is more predictable and less transaction cost intensive to really enable financial solutions to build on market mechanisms, to integrate revenues generated with market mechanisms, for example, into project finance structures, what did not really succeed in the past under the Kyoto Protocol. So if this is a vision, then the perspective on results-based climate financing is a different one. If you aim for integrating better finance and markets, naturally you are interested in a financing instrument that has strong market features. And that is what results-based financing is. It is basically providing a price signal for climate outcomes through a financing approach, enabling market development and supporting domestic policy processes. So that is a reason why we started that work, not to shed light on something that is still niche, but to think through what could that approach mean in a broader strategic context. Let me start now on the content of the report to give you a bit of terminology here that will help us to go through these slides. So in the following, we define climate finance really as a support activity that is not linked to any transfer of assets for NDC compliance purpose to the provider of climate finance. Whereas climate markets mechanism we would define as a type of international interaction where assets are transferred for NDC compliance of the provider of the payment. So it's a major difference. And results-based climate financing, as a name indicates, belongs to this universe of climate finance. We define it also as a modality of climate finance. And with a modality, as different from instrument, we mean an approach where finance is delivered for results, as opposed to an approach where finance is provided upfront. Upfront financing would be another modality of climate finance. This wording is important because we don't want to confuse the financing approach with the financing instruments. Results-based climate financing can be delivered, and we will see these examples through a suite of instruments, including grants, payments for all type of climate and carbon credits, as long as they are not used for compliance purposes, or even loans and guarantee instruments, as it is the case for upfront financing. Therefore, we need these two layers of terminology of a financing approach and financing instruments. So carbon crediting, which we have seen at scale under the Kyoto Protocol through the clean development mechanism, can in principle be both climate finance or climate market mechanisms. Under the Kyoto Protocol, it used to be primarily a climate market mechanism, as these carbon assets were used for compliance purposes. But more and more, with the collapse of the Kyoto carbon market, we are seeing certain carbon standards, including the CDM, being used to deliver finance where the carbon assets are not used then for compliance purposes by the finance provider, and that would then fall in the universe of results-based financing. So let's now move to continuing this exercise on terminology. I know that's a bit dry, but we need to go through this in order to be on the same page on what we are talking about. So what definition of results-based climate financing are we using in this report? Basically, we define results-based climate financing as finance provided for climate mitigation or adaptation results. Think about emission reduction, think about units of clean technology like cook stoves distributed, think about green kilowatt hours electricity delivered to a grid, or think about farmers, to take an adaptation example, equipped with weather insurance. All these would be, and there are many more, climate mitigation or adaptation results that accrue at the end of the results chain that you see at the very bottom here. We are really not talking about inputs, not talking about activities. We are talking about outputs or outcomes that ultimately would then lead to the desired impact of achieving a low carbon and resilient development. So the key criteria is payments are made for results, for climate results. They are made ex post once these results are delivered. These results are predefined and they will be independently verified. That is the definition of results-based climate financing adapted in that report. Now, why implementing results-based financing? In the beginning, I already provided you with a strategic context, but getting now more into the details and the findings of the report. Basically, the report found two rationales for using results-based approaches in climate. One rationale is, let me call it, and it is called like that in the literature, the principal agent rationale. It is about aligning the objectives of the principal, the funder, with those of the agent, the one that is receiving funds. The goal is to focus more and increase the focus of the agent on results, and to provide the agent, of course, with a maximum space of finding the best solutions to achieve those results. Obviously, this is shifting risk of non-delivery of results from the principal to the agent, and the agent need to be in a position to manage, to handle these risks. This principal-agent rationale is certainly more relevant in applications of results-based financing addressing directly the private sector and private project entities. It is dominant in the literature on results-based financing in general. But there is a different rationale as well, and this rationale is one that comes much more from the practice of results-based financing. It is much more a practitioner view, built on the basis of experience with concrete projects and related policy dialogues. And this structural change rationale, as we call it here, really focus on the very fact that results-based approaches can positively support and influence policy implementation processes, not in the sense that they make policies happen that would not, that do not correspond really to the original intent of the policymakers, of course, but in the sense that they help to focus these results-based approaches on what matters in policy implementation, that is to achieve the desired results and to build in a targeted way the capacity you need. We often have in development finance a sequential vision of how things are happening, going from knowledge over technical assistance to concrete operation. Results-based financing is to some degree reversing this causality chain in starting with what the real objective is and what the target is, and building from there backwards the capacity you need, with a clear advantage that capacity is very targeted and linked to the concrete policy intent and to the concrete operation. So on these two notes, so more on the private sector side, the feature of results-based financing really to mandate those that are best informed with finding the solutions, and on the public sector side, if you want to support policymakers to stay on track, to be targeted, and to build the required capacity for the policy intent. I move now to the concrete results of the report in terms of findings on the results-based financing landscape. Let's start with the macro perspective. So this chart here shows you several things. It shows you the capitalization of the 12 largest results-based climate financing initiatives that currently exists over time. And you see, first of all, the order of magnitude. Currently, that is this year, results-based financing stands about at $2.6 billion capitalization of the results-based climate financing vehicles, funds, so to say. That is different from disbursements, of course. That is a stock, not a flow. And you see that was pretty stable since, say, 2008, and it basically reflects this plateau here from 2008 more or less until 2016. It reflects the early stage climate financing that from which results-based financing could also benefit in terms of capitalizations, the existing results-based climate financing facilities. So what you also see is that these numbers are in a business as usual scenario declining sharply, more or less from now on over the next years until they almost disappear by end of this by end of the next decade. And the reason for that is that this money will be dispersed and it will be gone then, and therefore without further capitalization of these funds, that would be more or less a time profile of available funding for results-based purposes in developing countries. You also see here a color coding. You see that the color green is completely dominant, and green stands for forestry and land use sector. And that reflects that results-based financing in climate these days is mostly for RED+. The reason is that RED+ started early, so forestry protection started very early in as a key climate change activity, a key mitigation activity, and it is recognized under the Paris Agreement as a priority area for results-based financing. And so most of this funding that is here pictured in this chart is indeed for reducing emissions through reducing deforestation activities, RED+. You see also that the energy sector is the next biggest one. These are these additions in blue, but they are really dwarfed by the green sector, by the forestry sector. Now let us look at, I told you that this is capitalization of the 12 largest funds, both including multilateral funds and bilateral programs. Let me show you now the disbursement, the expected disbursement pattern, which mirrors somewhat the picture we have seen, but with a time delay. The time delay is simply due to preparing the programs and to dispersing these funding results based. You see that we are currently at about 280 million annual disbursements in 2015 and 2016, and we will peak likely 1 or 2 years from now, reaching 400 million a year. If you compare these numbers with international public climate finance delivered in total, you will find that this number is very small. The international public climate finance delivered according to the last OECD report is in an order of magnitude of 40 billion per year. Here we are talking about a maximum of 400 million, underlining that point that despite the potential that this approach has, at least in the assessment we did in our report, it is still marginal in the overall landscape of results-based financing. Now let's move to some more findings from that report. Where is results-based financing located? Where are these programs implemented? What we did here is simply to count the programs by region of implementation. You see it does not add up to 74, but a bit more. That is because some of these programs are multi-country programs, but still the picture is pretty clear. We see a strong representation of low-income countries, sub-Saharan Africa, but also South Asia. We would see an even stronger representation of these low-income countries if we had reflected here in this pie chart, not the number of programs, but the funding volumes, as a lot of these forestry programs that I have shown you in terms of overall volumes in the previous slides are located in low-income countries. This is a very interesting finding, and it is an interesting finding because often in the literature we find statements that results-based finance is sophisticated. It requires substantial capacity on the ground. This tells us a different story, and this links to what I said earlier on the structural change view of results-based financing. It is actually an instrument that helps to build capacity. So it goes the other way as well. And this is why you find low-income countries so strongly represented here in this overall RBCF portfolio. RBCF is a very results-based climate financing, a very flexible approach. We will see more about that, but let's continue with the actors that are incentivized, that are targeted by the various programs we have looked at. And what you see here is that most of the programs we have assessed are targeting the project stakeholders. So as project entities directly, the private sector or public sector implementation agencies. Considerable number are also targeting host countries. Less so implementing agencies. Implementing agencies are to a much lower degree targeted by results-based approaches, and this is to be kept in mind when thinking about improving existing approaches and increasing efficiency of such approaches.
Klaus, I can give you a second to drink also some water. I just want to mention that we already have some questions in the web. So I would like you to encourage people that are participating, and I can see there are a couple of participants in the webinar, to go ahead and ask your questions to Klaus. We have a couple of more slides, and then we're going to conclude with some case studies. So we'll make sure that we'll have some time for discussion. Please, Klaus, continue. I hope you have your water.
Thank you. Thank you, Aris. Very much appreciated. So variations in design of results-based climate financing programs. As I already mentioned, results-based climate financing is delivered through different financial instruments, grants, loans, risk mitigation instruments. And it is also typically combined with other financing modalities like upfront financing or technical assistance. That is important because only under very specific constellations can entities targeted by results-based financing complement for the investment financing needs, raise the needed capital on capital markets. That is not in general the case, and that is why we find this feature that results-based financing is mostly, in most cases, packaged to broader financial and policy activities. Results can be defined in very different ways, and I already alluded to that. So we call that in the results-based climate finance community disbursement linked indicators, DLIs. These are basically the parameters that trigger payment. And they reflect the mitigation and adaptation or development target. And they can be designed in very different ways. And you will find that if you take the time to go through this report, you will find a broad range of options to design the disbursement-linked indicators of a results-based climate financing program. Just to mention a couple of options. It can be unit-based, or it can be threshold-based, in the sense you disperse once a threshold for a parameter is reached, or for each unit of the desired output or outcome delivered. We also find qualitative indicators, and we find that qualitative and quantitative indicators can be used in combination. Many programs are using several disbursement-linked indicators following a series of chains that is specific to these programs. Institutional structure is also a key design element, and it supports the focus of project implementers or policymakers, obviously, on results. That is a key objective, and strengthens domestic institutions and infrastructure. Let's now move to a couple of examples, and I will only say one sentence to these examples and not read you through all of these slides. And they illustrate more or less what I said in more generic terms in the previous slide. The first example I want to give you is it's a program in Uganda called the Global Energy Transfer Feed-in Tariff Program. And what this program basically does is to integrate results-based climate financing into a policy in a developing country, in the country of Uganda. This country has introduced a feed-in tariff system for renewable energy. And what an international donor community is doing, they are topping up these feed-in tariffs. That is, they are paying a premium on these feed-in tariffs to improve the incentives that this policy has to attract private sector investors. And that is an example I wanted to present from a perspective of how results-based financing can facilitate and support transformational change. Because this is really what this program is about. It is about reforming the power sector through domestic policies, and results-based financing is here fully integrated in this domestic policy, supporting the objective of the government of Uganda. The next example is an example of a completely different type, where the focus is more on cost efficiency and fast track disbursement of climate financing to incentivize private investment. And the example here is a pilot auction facility of the World Bank. What is done here is that results-based payments are provided for emission reductions achieved with methane reduction projects through private sector investment. And the interesting feature is that the program is using a reverse auction, meaning those that are offering methane reductions at the lowest price are included in the program. And they are included in a very innovative way, in the sense that they purchase a put option that they can draw to sell to the pilot auction facility, but they are not obliged to sell to the pilot auction facility. In case a new market emerged, they could also take advantage of a potential higher price in this new market. And a further feature is these entities, they can trade the put options and sell the put options. That avoids a lock-in of programs that might not succeed in the future, and enables the facility to optimize its portfolio. And of course, it protects those that purchase the put option from a stranded investment, as they can sell these put options. So this is very different from the first program. This is not about transformational change. This is about fast track delivery of climate financing in the most cost efficient and flexible way to the private sector. Example number 3 is an example on scaling up. And this program is the Rural Electrification and Renewable Energy Development Program in Bangladesh, which has the objective to really boost rural electrification and renewable energy development in the country of Bangladesh. The program works with results-based grants. It has achieved a volume of about 400 million in financing electricity access, household energy efficient lighting, including household energy efficient lighting. And what we have seen so far is quite impressive in terms of numbers. So 650,000 new connections to the power grid in the off-grid area, 2 million solar home systems installed. And thanks to that success and to the capacity that was built with this program, it is now possible to set up a second tranche to considerable scale up this activity. So that is a further feature I wanted to illustrate of results-based financing. I wanted to illustrate with this example. Once you have created the implementation structure, infrastructure, and the capacity, you can easily scale up. What is the difference to a more upfront financing approaches? Now, these were all examples in mitigation. The final examples I have to offer to you is on adaptation, and this is the results for Rural Resilience Initiative. This is a program that is implemented in Ethiopia, and it is all about providing weather insurance to poor farmers. And it has a two-stage results-based financing, a two-layer results-based financing structure. First, it provides payments to, if you want, the supply side, to insurers in buying down the insurance premiums. And it is done, of course, per insurance provided to poor farmers. This is a results-based feature of the program. But then it is also providing results-based payments to the farmers, because the farmers have the opportunity to earn cash vouchers for resilience works they are doing by themselves, earning access to, or better access to these weather insurance. So it is a two-layer results-based financing programs addressing both the demand side and the supply side. And it is one of the first examples that we see in adaptation. We have seen that this example was replicated in a couple of other countries, like in Morocco at a larger scale, and it seems to be a promising approach in the area of adaptation. So that makes these examples complete. I now offer you a few conclusions on that we have drawn in this report. We concluded that results-based financing, which is, as of today, a common approach in health and education, but not in finance, in climate, is very suitable for climate action, particularly suitable for climate, in particular for climate mitigation. And this is because it focuses on a global externality that is well defined, that is measurable, and where the causal link between this global externality and the desired effect, meaning mitigating climate change, is extremely strong, stronger than in other sectors. Think about education. You set up results-based financing scheme to improve results of students' exams. The ultimate objective is to improve education levels, but the causality, obviously, between passing an exam and being educated is a much weaker one than reducing emissions and achieving below 2 degrees in the long run. So that is number one. Number two is results-based financing has demonstrated potential in adaptation. We have seen this example for the weather insurance market, albeit that is so far through fewer programs and mitigation. Results-based financing, and this is something we have seen again and again with the examples studied, can facilitate market creation and pricing of climate results, in particular of carbon emissions. It can support host countries' policy processes to achieve their nationally determined contributions under the Paris Agreement through this targeted capacity development and support of policy processes. And it can leverage private sector activity and financing. We concluded it can play a critical role in mobilizing the resources needed to achieve the objectives of the Paris Agreement. I stop here and I thank you for your attention. And I'm open for questions.
Thank you. Excellent. Thank you very much, Klaus, for this presentation. And I think we have enough time for questions to you. I would like to, I think we have like 3 questions already in the chat, but again, I would like to encourage you, anyone who is participating, to post the question. It's a great opportunity to, to get a little bit of like understanding of the opportunity for results-based climate finance. And I'll take the opportunity of like being a moderator here in order to add a conclusion, actually. I mean, to provoke you by adding a conclusion to what you said. And coming from GPOBA, which since 2003 has developed results-based approaches, one of the issues in terms of like benefits that we can see results-based climate finance playing a role is the role of like combining 2 different agendas. Our work has been focusing a lot on infrastructure. The results-based climate finance opens the space beyond carbon pricing. I was wondering, and while at the same time the challenges in terms of like development of infrastructure and achieving climate mitigation goals is very, very strong. So I was wondering, how do you see this kind of role of results-based climate finance as an agenda that goes beyond, I would say, strict and silos of certain practitioners playing around?
Yeah, that is an excellent question, Ari. Thanks for that. Indeed, I think, and this is what we found also in assessing the programs we looked at in this report, that results-based financing can help to better integrate the climate agenda into the development agenda, into the development finance agenda, because it is integrated typically with other financing solutions, and it can add on existing development financing programs and improve their climate performance, both on the adaptation and mitigation side. So as well as on this agenda of better integrating climate and development, results-based financing has interesting features that can be taken advantage of.
Now I would like to go to the question of Main Astonitas, if I read the name correctly, which goes back to essentially to the principle of like how do you develop like a results framework for a project. No?
Mm-hmm.
I think what you have presented us here and through our work, we have realized that essentially what results-based financing approaches in general require, especially for climate, is like a very robust results framework in terms of like identifying what would be the outputs, what would be the outcomes, and what would be down the road the impacts. And there are like certain challenges, of course, I mean, in terms of like defining upfront the impacts, while at the same time it's much easier to define the outputs or the outcomes. Through this kind of like analysis that you have done, what do you think I mean, how do you assess this kind of, how do you explain the fact that, I mean, forestry projects and energy projects have saved up the biggest part of the portfolio of results-based climate finance compared to other projects? Is this related to how that is easier to define outputs and outcomes to the sectors, or is there another reason?
There is another reason, I think, for this dominance of forestry programs, because in particular in forestry, it is challenging to define the right methodology to measure reduced deforestation. And most of the forestry facilities, they took quite some time in coming up with these methodologies that are now available. And the same is true for the UNFCCC process, or only in the Warsaw COP. It was possible a couple of years ago to come up with a framework for results-based financing in forestry. It is simply very difficult to establish the baseline against which you measure decline in deforestation. So it was not, therefore, it was not driven, this prominence of results-based financing in forestry. It was certainly not driven by the ease of measuring and of defining the DLIs in the sector. It was rather driven by an understanding that in order to protect forests, it is just not good enough to do an input-based activity and to do an investment, you need to provide a continuous incentive to keep the forest alive. And that is exactly what you are doing through results-based payments. Also, the cost structure here is somewhat more favorable to results-based financing approaches, to a generation one, I should say, type of results-based financing approach, because you are dealing here with less capital-intensive interventions than in energy, for example. So you would need in energy more financial sophistication to design results-based financing programs than in forestry. And that makes it a natural starting point, actually. But it's not on the DLI side, more on the economics of the sector itself.
Excellent. Thank you very much. And I mean, continuing the discussion on energy, you presented the case of Bangladesh, the REDET program, which was actually supported by GPOBA, which has been successfully now is being scaled up. I would like to link this kind of agenda with the broader agenda of like how can we have transformational change. And I think the Paris Agreement with the NDC framework that provides for countries to support climate change mitigation, potentially can play a role on this kind of thing. How do you see the role of results-based climate finance playing a role within the context of national, of NDCs, of the national climate contributions of each country? Is there a role for results-based climate finance in this agenda?
Yeah, definitely. We presented results-based climate financing in this report from the angle of international support. But there is a domestic agenda on results-based financing as well. And that is something that countries might want to consider that have ambitious NDCs and targets. And these targets are quantified. The countries want to achieve these targets and they want to be able to report on these targets and to comply with their international obligations, not necessarily obligations to achieve, but obligations to report at least. And that is something that speaks very much to deploy results-based financing in a national context as well. And what you were saying earlier on renewable energy, we have a lot of experience, in particular on a domestic level, how successful transformation of the energy sector towards renewables look like. It is always the same model that countries are applying. There is a regulatory policy guaranteeing grid access, and there is a sort of a market mechanism, be it a renewable certificate standard, be it a feed-in tariff system, and then there is in the beginning upfront financing, and over time this mix of instruments is changing more and more towards a self-sustaining market solution based only on the feed-in tariff, which in itself can then decline over time once technology costs are coming down. And that is a perfect example how the results-based financing approach can be used purely domestically to achieve transformation change.
Excellent. And how about the private sector? We talked about that results-based climate finance is a niche in the overall climate agenda. At the same time, plenty of reports are also mentioning that funds from multilateral institutions, public funds are not there in order to provide. Cannot cover the needs that were had. The needs that need to be covered in terms of like achieving our goals from the Paris. So the private sector needs to step in. How do you see the role of results-based climate finance agenda within the context of like incentivizing private sector actions, both in terms of like financing projects, but also in terms of developing markets?
Yeah, it's true that the bulk of funding available for results-based programs is coming from the private sector. But we see pockets of funding made available by the private sector as well, in particular in the voluntary carbon markets. Um, that these activities are mainly driven by social responsibility considerations. We find big firms involved here. And of course, for as a private sector, what matters is to achieve results, and they are accountable for achieving results. And that is a reason why private business aiming to support a clean development agenda, including from a purely philanthropical point of view, might find results-based approaches particularly interesting because that comes very close to the way private companies are doing business. It is to produce results and to report on results and not to risk investments that might not result in really what they aim to achieve when it comes to activities outside their own core business.
So what prevents us from doing more results-based climate finance? I mean, from your analysis, what are the main constraints in terms of like scaling up this agenda, supporting private sector action, strengthening institutional capacity? We have analyzed 74 programs here.
Yeah.
Are there any kind of like lessons learned that we can take upfront in order to support the results-based finance agenda for climate moving forward?
I mean, a simplistic answer would be money, because I have shown you that the overall funding envelope for results-based approaches is still very small, in particular outside the forestry sector, taking into account that we are really living in an area of particular scarcity of public funding, in particular in the climate agenda. A more sophisticated answer would be really knowledge and understanding about a broader strategy on how best to deploy the little amount of climate financing that is available, and how best to take opportunity of market mechanisms and potentially new market mechanisms emerging. So a lack of knowledge is also a key barrier, and that was the main reason why we did that work on that report, to contribute to reduce this knowledge gap. This work is not yet done; it still exists, and we are just at the beginning. But I really believe that improving understanding of results-based financing can help to do more of it.
And at least from my side, when I was reading the report, I think that there's a great contribution with the report by identifying, by going back to what you said in terms of like terminology, identifying, when we're speaking about climate finance, carbon finance, climate markets, what is the right terminology that we have to come up together as a development community, as climate practitioners, towards our stakeholders, our clients, in order to shape this kind of agenda in terms of like providing solutions. So in this kind of context, I think the report is a very, very important contribution. I don't know if there are any questions more from the participants in this kind of webinar. I feel that I mentioned. I had the privilege of like asking plenty of questions. I'm seeing a question now here from Naisa Ahuja. What kind of legal challenges can be expected in terms of like when you are developing results-based climate finance results-based climate finance projects? From GPOBA, we know these kind of things, that it's important to leave some space and build the institutional capacity in order to develop, like down the road, successful results-based financing results-based financing approaches, particularly in infrastructure. How about climate? Especially from a developing country, in a developing country context.
So the question was about
the legal challenges.
The legal challenges, yes. Property rights, that is a key legal challenge here. It starts with, let's take the most obvious example of emission reductions. You are reducing emissions, as an operator of a wind park. Who owns these emission reductions? Is it you because you did the investment, or is it a fossil fuel powered plant, because it is there where the emission reductions occur, as less of this fossil fuel powered electricity produced, that is a legal challenge, and you find similar legal challenges, say, in the forestry sector, on land ownership, and so forth. And you will face these challenges when developing and implementing results-based financing programs. But on the other hand, they are not only challenges, they are also opportunities to fix problems that exist in a country. Because if you don't have an idea of who owns emission reductions and who is liable on the other hand of emissions, it is very hard to tackle the problem. And that is a further case where the argument can work the other way around. Yes, it's a challenge, it's a major challenge, very difficult to do in many results-based financing programs. But once you have done it, you have achieved something that goes much beyond what is needed in the program and has a positive effect in the whole sector.
But this is related to domestic policies, or it's related to I was thinking about, again, but this relates to the question also, incentivizing the private sector. Do you think that the legal kind of framework is an obstacle for the private sector coming and taking the pre-financing, the upfront financing type of like arrangement, risk, call it whatever you want? I mean, is there a legal challenge there? I mean, from your experience, or is like
for receiving the upfront financing, certainly not, because that is in countries where there is a capital market, there is access to this capital market that is purely a private business issue. But the problem, as I said, is about the property rights of the result itself as a basis of this whole business model.
Great. With this, I think we're arriving to the closure of this webinar. It has been a great pleasure for me to be here with Klaus Oppermann, who shared with us his insights about results-based climate finance. I think I keep many of the things that we discussed, particularly with regards to how do we bring the climate and the poverty agenda together and the whole development agenda together. I think this can be an important thing. I mean, the issue of doing more on adaptation and how do we support countries in terms of like as they are developing their NDCs on having results-based climate finance approaches. This was just a webinar, and there are more webinars that will be coming both from GPOBA, I mean on other subjects, from GPOBA on climate, but also on other subjects. So I would like you to stay tuned for those participating. It was great to be here, and I would like to thank Klaus for his participation in this webinar. Thank you very much all.
Thanks, Harris.